With this video, we complete the normal syllabus of the banking awareness that was going on for a long time. So these 16 videos plus one that I had made earlier, so a total of 17 videos, they are going to be very useful for all your banking awareness preparation. For RBI Assistant Mains that is coming up, these are sufficient and you can just use them for your preparation. And for SBI PO, there are a few fringe topics that I will be covering later on. So they will be coming on a little later. And also for the updates to the banking things, so all those things I have covered in the videos that I have already done, and also for the glossary and the abbreviations I might later on make a video. So if you have any suggestions about topics that I should be covering in this series, then let me know. For SBI PO, I'll definitely try and make some more videos. So let's start this video. Hi, this is Supriyo. So let's start with inflation. So what is inflation? That's very important to understand. Inflation means that the prices in an economy are gradually increasing day by day. So just think about it, that today if you are buying an object, 10 years later if you buy that same object, it will cost a lot more, isn't it? So that is due to inflation. And remember that the general price levels are going to be increasing while the purchasing power of the money is going to go down. So these are the two things that accompany inflation, and this is the general sentiment about inflation. And what are the types of inflation? Now this is very important because in many exams you are going to get these types of questions about the types of inflation. So let us take a look at some standard types. So the first type of inflation, it is the cost push inflation. So what is this? Cost push. So this means that there is an increase of the input price, so there is less supply. So this means that whenever you are making an item, you are putting some inputs into it, right? You are putting labor into it, you are putting any kind of materials into it. So if those prices are increasing, what happens? Your exact that item that you are manufacturing, the price goes up, and so this item becomes much more costly to actually manufacture, and that means that the supply is reduced. So this is very important, that cost push inflation is a supply side type of inflation. So the supply problems, they actually make something very much more expensive. And always when you are thinking about inflation, remember that if there are a lot of something, then that thing is not that much valuable to you, right? So if you have a lot of anything in your life, then you do not value that thing. However, if you have only one, then it is much more valuable to you. So you can always think like this, that if there are less number of items, then each item will become much more valuable. So that is a good kind of analogy to use as you go through inflation and study all these things. So the second type, it is the demand pull inflation. Now this is a demand side inflation. There are two sides you have to always remember. There is the supply side and there is the demand side. So this is a demand side of inflation. This means that there is high demand but the supply cannot match the exact demand. So to understand this, just think about, for example, your hand wash or your sanitizers. So during the pandemic, what happened? We had a sudden surge of demand for all those sanitizers, and that is why in the market you could hardly get any sanitizers. So this item, the sanitizer, the demand for it shot up and the supply could not actually match it, and that is why it was a demand pull type of inflation. And the next thing is the galloping inflation. Now this is any kind of inflation which is in the double or the triple digits. So the inflation rate, if it is in the double or triple digits, then it is called galloping inflation. And then you have the hyperinflation. Now hyperinflation is the worst thing for an economy. This means that you have very high inflation and it erodes the value of your currency. Now some countries that actually face this were Venezuela, and you also had that in Zimbabwe. These countries, the currency value reduced so much, there was almost sometimes 1,000,000% inflation. Now these types of things, when they happen, then the strength of your currency of a country goes down rapidly and you go through an economic recession. The next thing is disinflation. So this means a temporary slowdown in your inflation rate. Then you have the bottleneck inflation. This means that only the supply falls drastically but the demand remains the same. So that can actually lead to inflation. And then you have something very important called deflation. This is also something that is a concern in many developed countries because the inflation can fall below 0% and the currency value, it goes up. So this is actually happening when you do not have enough money in the the economy and your money supply is actually reducing. So each and every unit of money that you have, it actually becomes much more valuable, and it's not seen much in the emerging markets in the developing countries, but mostly in the advanced economies it can happen. And then you have the stagflation. Now this means high inflation, high unemployment and low growth. And finally you have the creeping inflation. So this is the slow increase of inflation over time. Now remember that in inflation there are various graphs as well, so I'm not going into those things because they are for some higher exams. Maybe some other day I'll go into deep about these things, but for our normal bank exams, this type of information, this much is enough. So let's move to the next thing. So how can we measure the inflation? Now this is very important. When you are measuring the inflation, you can basically use many types of indexes. So you have different inflation indexes that help us understand how much the inflation has increased in the economy. And to actually do that, we use something called the base year. So the base year means the year which you actually set as a benchmark, and the other years you are actually comparing to that year. So understand this concept. One year you have to fix as a base year, right? So that you have to calculate a percentage, but the percentage of what? These inflations that you see in the market, when you read the newspapers, you might see 4%, 5%, 6% inflation. So they are a percentage of what? They are actually compared with the base year prices. So always remember that a base year, it has to be a normal year. You cannot have any kind of droughts, you cannot have any earthquakes or any floods or any kind of natural calamities in that base year, so that the base year is just a normal year, not an abnormal year, and on top of that you are calculating your inflation percentage. Now let's take a look at the most important indexes of inflation that we have. We have two which are most important, CPI and WPI. Let's take a look at CPI first. So CPI, it actually means Consumer Price Index, and it also is called the retail inflation. Very important. Whenever somebody says retail inflation, you have to say that it is the CPI that they are talking about. So very important to remember that RBI uses the CPI combined metric to measure the inflation in India. Now earlier the RBI used to measure it using the WPI, but now since CPI is actually geared towards the retail customers, they have moved to the CPI combined metric to measure the inflation in India. And the data for the inflation, it is released by CSO, or the Central Statistics Office, under the MOSPI, which is the Ministry of Statistics and Program Implementation. The base year for the CPI, it is 2012, so remember that. And you have different baskets for measuring this CPI. Now a basket is basically a collection of items that people are actually buying. So these baskets, they actually just consider how many types of items and what's the weight of each item that each person actually buys. Because just think about it, that if you are buying soap, maybe you have to buy it much more frequently, right? But say you are buying toothbrushes, so toothbrushes do not need to be bought that frequently. So like this, they are actually categorizing different items and putting a weight on each item so that we can actually calculate the inflation of each and every item. Now CPI rural basket, it actually contains 448 items, and the CPI urban basket, it contains 460 items. So a total of 908 items we have in both the baskets combined. Another important thing to remember is the core inflation. So what is a core inflation? You will sometimes see that the papers say this. So core inflation is your headline inflation minus the food and the fuel inflation. So the headline number, it is the total combined number, and you are actually minusing the food and fuel, because food and fuel, they are prone to a lot of fluctuations, because the oil prices can go up and it can just increase the prices quite high, isn't it? So that is why we just deduct these items and we just go into the core inflation, the thing that does not change that frequently. So it's very important to understand, because it gives us an idea about the general inflation level in our domestic economy. And there are 4 CPI types. So remember this, it's very important. There is the CPI for the industrial worker, there is the CPI for agricultural laborer, there is the CPI for rural laborer, and the CPI for rural, urban and combined. So this CPI combined, this is the most important important thing for RBI purposes, because by that we can understand the inflation level. And also remember that the Labor Bureau, it compiles the first three and the fourth one. So this one, it is actually done by the CSO. So these three, they are actually compiled by the Labor Bureau. So remember that. And also another important recent event was that CPI IW or CPI Industrial Workers base year has recently been revised to 2016 from the earlier figure of 2001. So these are the important things that you need to remember. If you cannot remember each and every number, it is okay. Just remember the general idea that I have explained to you, because it's going to be very important. Just remember this thing as well, which is the CPI calculation. So how do you calculate it? You can just divide the consumer price index in the current period divided by the consumer price index in the base period, and you multiply it by 100. So this is how the CPI is actually calculated. And now let us move to the WPI, or the wholesale price index. Now remember that the wholesale price index, this is kind of a producer index. So it is from the point of view of the companies, of the manufacturers, while the CPI, it was for retail, it was for you and me, the common man. So remember this important distinction. And the data for the WPI, it is released by the OEA, the Office of the Economic Advisor, under the DIPP, the Department of Industrial Policy and Promotion, under MOCI, or the Ministry of Commerce and Industry. Very important. And the base year also very important. It is 2011 to 12. It was updated earlier from 2004 and 5. And the number of items for the WPI, it is 697. This was also updated to reflect the current trend. And the WPI also does not count any services. So this is very important to understand. No services calculations are done in the WPI, but it has a WPI food index. So a separate index they publish for the food inflation, which is the WPI food index. And they have three subcategories. As I told you that they will be weighing each and every type of articles. So they have primary articles. So these are the food articles, minerals and some other things. The weight of this is 22.62%. The fuel and the power items, which are weighed at 13.15%. And then you have the manufactured products, which have the highest weight in the WPI at 64.23%. So that is why this is a producer index. This is something that helps us understand the inflation level from the point of view of the companies or the manufacturers. And the WPI, it does not also include the indirect taxes. So there is no fiscal policy impact. Now just remember this, they are a little bit higher concept, so I'm not going deep into it, that they are not including the indirect taxes because of some important distinctions that were actually demanded by the IMF. So it was done to actually conform with the global standards. So no need to get into deep about that. So that is how your WPI is calculated. And you also have some other indexes. So remember these also. So there are the IIP, or the Index of Industrial Production. Now this has 809 items in total. It is also published by the CSO, and it has the base year of 2011 and 12. So this basically captures some things that are missing in the WPI, and so they have come out with that one. And then you also have something called the GDP deflator. Now the details are not required. So the GDP current prices divided by the GDP at constant prices, that gives you the GDP deflator, and it actually helps us to arrive from the GDP calculations what is the current inflation level. But in India it is not much used. And you also have the PFCE deflator. This is sometimes used. So PFCE means private final consumption expenditure. So that's another metric. Then you have the Residex index. Now this is also something that is sometimes asked. So this is prepared by the NHB, the National Housing Bank, and it helps us understand what's the trend of the prices for the real estate industry. And then you have the very important inflation expectation survey. Now this is a survey that is done by the Reserve Bank of India, and they actually survey many households to understand what are their expectations of the inflation. So that's also something. And then you have the PPI, or the producer price index. Now in India the PPI is not much used, but right now the Niti Aayog has actually set up a working group under Ramesh Chand, who are actually trying to update the WPI and create a PPI. So from WPI, we are going to go to PPI very soon, and this working group, they are going to help us achieve it. So that's the latest thing that you need to remember. And now let us move to the next thing, which is the international financial organizations. The most important of these organizations are the Bretton Woods twins, which are the World Bank and the IMF. Now, how did these organizations actually start? So in 1944, after the World War II had ended, people understood that the world needed a financial organizations to bring people and countries together. So 44 countries in 1944, they met in the Bretton Woods conference in the USA. And so we had the birth of two organizations, the World Bank and the IMF. At that point of time, the World Bank was called the IBRD, or the International Bank for Reconstruction and Development. And these two organizations, they thought that we are going to control all the important things in the world economy to ensure monetary stability. So the IMF, its main purpose was to actually help for the monetary stability of the entire world, and the IMF sometimes gives loans to some countries which are struggling at this point of time, and they are trying to maintain all these economies so that any major crisis in the world can be averted. And the World Bank, they are actually financing all the underdeveloped nations, all the nations which are struggling right now, and they are trying to get them out of poverty so that they can lead normal lives. So these are the two institutions, the most important ones, and both of these institutions have 190 members, and the latest country to join them was the Principality of Andorra, which had actually joined in October of 2020. So right now they have 190 members. And just remember something, that this Bretton Woods concept, this actually started in 1944, right? And the concept that they started, it was actually the gold standard, because the currency, it was actually pegged to gold. Now in 1971, this actually ended by something called the Nixon shock. So we have already discussed this in our session, I hope that you remember. So we could earlier exchange the dollars for gold, but in 1971 it all ended. So this was the most important period for the Bretton Woods twins, and just remember these specifics. And also the other important organization is the BIS, which is the Bank for International Settlements, and this is a bank of all the central banks, so remember that. And you have the World Trade Organization, so this regulates the trade between different countries. You have the NDB, or the New Development Bank, which is also called the BRICS Bank. Now BRICS countries, they are actually very developing countries: Brazil, Russia, India, China and South Africa. So they thought that we should get together and create a different bank, and indirectly they have challenged the IMF or the World Bank. And although the BRICS Bank said that we are not challenging anyone, this is not something that is hidden, and they wanted to have a different financial center in the world, so that is why it was actually created. Then you have the FATF, or the Financial Action Task Force. So their main purpose is AML and CFT, which is the anti-money laundering and the combating of financial terrorism. FATF has different lists. So just remember that recently Pakistan had actually escaped from being put in the blacklist of the FATF, and they have been put into the grey list. So they have different lists of countries to ensure that each country that is being dealt with are following all the rules. And the ECB is the European Central Bank for the 19 European Union countries with the euro as their currency. Now let's take a look at the different financial organizations, and I have made a list here. So just remember the headquarters and the key people. Not all of these are financial organizations, but questions have come from these organizations. So please remember these things. I'm not reading this out. You can take a look yourself. So I have put the organization, the headquarter and the key people. And remember the Indians in the list, like in the World Bank, you have Anshula Kant as the MD or the CFO. In the IMF, you have the Geeta Gopinath as chief economist, and also you have in the New Development Bank Anil Kishore as the vice president. So these are the things that you have to remember, and also all the heads and the headquarters. If you are having a lot of difficulties to remember the key people, at least remember all the headquarters and the organization's names, because these two columns are the most important. So just ensure that you are remembering these things, because any exam can ask you these questions. So I'm not going into those. You can just make a note of them in your notebook, and you can revise all of these things. And now also you have to remember this thing about the European Union. So the European Union, it's very important. There are 27 member states of the European Union. Union. So 27 countries make it up, and there are 3 presidents actually, not 1 president. So the president of the Commission, it is Ursula von der Leyen, then the president of the Parliament, which is David Sassoli, and the president of the European Council, which is Charles Michel. And these 3 presidents actually run the European Union, which is headquartered in Brussels, Belgium. So remember that as well. And the presidency of the Council of the European Union right now is with Germany. And also remember that all the European Union countries, they do not accept the euro. So only 19 European countries, they belong to the Eurozone, which means that they accept the euro as their currency. So remember these things, because questions have been asked from these things as well. Let us move to the next thing, which is the foreign trade. Now, when we talk about foreign trade, we always have to understand the different types of economies, right? So the first important economy is the capitalist economy. In a capitalist economy, what happens is that the economy is totally dependent on the market. So whatever the market deems is necessary, the market creates, and the market also destroys. So everything is left to the market. The government does not get involved. So this is very important. Only minimal regulations are kept in place, and the market decides the rest. So this is a purely capitalist type of an economy, and America, UK, and most of the developed countries, they use a capitalist type of economy. Then you have the socialist economy. In the socialist economy, you are actually not in ownership of everything, but the state is actually considered to be the owner of everything. So almost everything belongs to the state, and this is also very similar to the communist type of government. So the Communist Manifesto that you know, it was written by Karl Marx and Friedrich Engels. So they were the key fathers of this movement, and socialism was practiced for a long time in the Soviet Union, and even Russia today, they are sort of following it, though they have a different kind of a political system in place. And of course, China is also one of the biggest countries that are right now following communism or socialism. So these are the 2 main important distinctions. And there is also a third type called the mixed economy, and India is actually a mixed economy. So we have the free market, which is a very important thing of the capitalists, and we also have government entities, which is from the socialist type of government. So we have tried to inculcate the best of both worlds in our economy, and it has gone reasonably well for us. And so these are the main important distinctions. You also have the distinction of the open and the closed economy. So an open economy is an economy that can trade with other economies, while a closed economy does not trade with any other countries. And as you understand, today almost every economy is an open economy. So if anybody asks you to give an example of a closed economy, you can say North Korea, but still North Korea is heavily dependent on China, so it is also sort of open. And then the difference between the FDI and the FPI. So FDI is the foreign direct investment, and FPI is the foreign portfolio investment. So how to remember this is that FDI, you can think about investing into a country without any kind of motive to get quick return. So you are investing for the long term, while the FPI, it is sometimes also called the hot money. So these are the kinds of funds that go into stock markets and for other speculative investments, so that they can make a quick buck. So that's the kind of a primary example, the primary difference. And also you can remember what the Arvind Mayaram panel had actually told us. So the Arvind Mayaram panel, they had actually defined FDI and FPI. So the foreign investment which is more than or equal to 10% is treated as FDI, and the investment, if it is less than 10%, it can be treated as FDI, subject to the condition that FDI stake is raised to 10% or beyond within 1 year. So even if you are investing less than 10%, if you promise that within 1 year I am going to raise it to 10% or above, then you can treat that as FDI. And also the foreign investment in unlisted company, regardless of a threshold, is always treated as FDI. Now the FPI, it also includes the FIIs and the QFIs. So they are the foreign institutional investors and the qualified foreign investors. So these are the differences, and they are very important because, as you know, that we have various kinds of FDI norms in place in India right now, and so it is very important to understand what is FDI and what is FPI and actually demarcate these two things. things. Now coming to the next important thing, it is the balance of payments. So essentially the balance of payments, it is a record of all the transactions that our country is doing with any other country, and this record, it is actually maintained with the governor of the Reserve Bank of India, and this is a very important thing so that which country can make their balance of payments and they can actually give it to the IMF, who can actually understand how the different kinds of currencies are transferred and how the world economy is actually going about. Now this is a very important thing. So let's take a look at what the balance of payments is. Now every country has a balance of payments and they are divided into two things. So the first thing is the current account and the second thing is the capital account. Now internationally we have a third thing called the financial account, but in India we do not practice that. We categorize in these two accounts itself. So the current account, what does this contain? This contains all the exports of a country. It contains the visible and the invisible exports. So what's the difference? The visible exports are all the goods, all the things that you can see which are exported, while the invisible exports are the services. Maybe if you are teaching somebody online and it's from a different country, then it is an invisible export. So these types of differences are there, and the imports are also categorized in your current account. So the visible and the invisible are actually placed here as well, and you have the unilateral transfers. So any kind of remittances that you are sending. So for example, if somebody is studying abroad and their parents are sending them money, then it is a remittance, and this type of remittance, it comes under unilateral transfers. And also the income like profits, interest, dividends, etc., all these things, they come under your current account. Now this current account, remember, in India it is fully convertible. So this means that you can freely convert all the dollars into rupee and vice versa if they are belonging to the current account. Now even though we have fully convertible current account, there are few restrictions, like we have something called the liberalized remittance scheme, the LRS, but these things are not very important right now, so we can talk about it some other day. And for all means and purposes, you can say that current account is fully convertible. And remember this very important thing, that the current account, the national assets and liabilities are unchanged when you are changing this account. So the asset and liability, nothing is changed. But in the capital account, what happens? The national assets and liabilities change if the capital account changes. So what does the capital account have? The capital account has all the investments. So what we were talking about, the FDI and the FPI, all things come under capital account. The loans and the investments, so any kind of sovereign loans. So if India is investing in some other country or some other country is investing in India, all these things, they are capital account transactions. Then you have the banking capital, which is part of the capital account. And also remember, very important, capital account is not fully convertible in India. This is very, very important, and you must remember this because it is a very important topic in India. And the first person who actually told us how you can actually make the capital account convertible, it was SS Tarapur, but those details are a little bit more complicated. We don't need this right now. Later on, maybe in some future video, I'll talk about it more. So that is all about your balance of payments. And remember something, that every country's balance of payments must sum to be zero so that everything is in balance. So this is something that's very important, but actually in practice it does not go to zero because of many kinds of things, but you have to actually get it to zero in a very theoretical aspect. And so this is all about the balance of payments. And we also have something called the balance of trade. So what is the balance of trade? It is defined as the difference between the visible exports minus the visible imports. So for India, remember, the balance of trade is always negative because we are a net importer of oil. So we import a lot of oil for us because our energy needs are quite high. So this is a very important thing. That is why we have something called the deficit in the current account, or the current account deficit, the CAD. Now this is very important. This means that our net exports are much less than our net imports. So this means that we always have to have a forex outflow so that we can maintain our country, we can just maintain our energy needs. And what is the impact of this current account deficit? So this means that we are always dependent on the other countries to send send us this material, and we have to keep spending foreign exchange on this aspect. Now these things are a little bit more complicated, so we don't need to go into that right now. Maybe in some other day, if you need a video, I can explain what is the impact of the current account deficit. For now, just remember that because we have that, we are actually trying to reduce our current account deficit so that India can become much more self-sufficient and we can have our fiscal deficits in control as well. So that's about the current account deficit. And we also used to have a body called the FIPB, which was the Foreign Investment Promotion Board. Now this body, earlier what it used to do was it used to actually approve all the FDI things that we are getting. So all the FDI requests, all the foreign money that was coming in, this body had to approve. Only then the companies could get it. But right now the government has actually relaxed all these norms and rationalized the FDI limits as well. So lot of FDI, it is under automatic route. So this automatic route means that the company does not need any permission to get that foreign funding. So these kinds of things have been done for ease of doing business, and right now we do not have it. We have something called the DPIIT, which is the Department for Promotion of Industry and Internal Trade. So remember the full form of the DPIIT. They are sometimes used in the FDI decisions right now, and this body does many of the work that earlier the FIPB was used to doing. And I have also taken another data set from the Reserve Bank of India website to help you understand the BOP. So as you can understand over here, these are the latest figures for the April to June period. The current account of India, as you can see, the net amount is $19.8 billion, and for the capital account and the financial account, this one you can see minus 19.3. So the net effect is that there is a slight shortfall. We do not have it entirely zero. So the RBI, they have done some errors and omissions, and the change in the reserves and everything they have calculated to make it minus 19.8. So as you can see, 19.8 over here minus 19.8. So our BOP, it comes to be zero. So this kind of a tally is done at a very higher level. So we don't need to know the specifics of it. Just understand that these are the figures for India currently. I wanted to show you just so you have a better idea. So let us move to the final part of this video, which is the credit rating agencies, or the CIC, which is the credit information companies. So the CRA or the CIC, they assign credit ratings to companies or individuals. So you can think of it like a report card. So every school child has a report card, right, that tells the teacher how he has performed. So in this way, the CRAs, they are actually giving ratings to the companies, they are giving ratings to the individuals and even to countries to tell the investors that whether this company is good or this individual is worthy to take a loan. So remember the credit rating for India right now. India right now has BBB minus or A3 or BAA3. So these things mean that we are at the lowest level of the investment grade countries. So that is the current rating that we have been given by all these CRAs. And also we have the CIBIL score and the CRIF high mark score. So CIBIL, what is the full form? It is the Credit Information Bureau India Limited, though right now it is only called CIBIL. So these CIBIL or the CRIF high mark scores, they help us understand if any individual is worthy of taking a loan. So they will do what? They will take all the credit reports from the different banks and the NBFCs, pool them together and then create your own credit score. So if you have taken a loan somewhere and you have not repaid that loan, then that report is reflected in your CIBIL score. So the CIBIL score, what is the range of the CIBIL score? It actually ranges from about 300 to 900. So that's the CIBIL score range, and your CIBIL score, if it is 700 or above, then it is considered to be an excellent CIBIL score. And also remember that if you get a score of -1, this means that there is no credit rating information for you, so you are taking the loan for the first time. So this type of a score, it helps the banks to understand that can I give the loan to this person, will he actually repay me or go away with the money. So that's one of the things that they use to decide whether they can give a loan. And the big three credit rating agencies in the world, so they control 95% of all the world business. They are the Moody's Investor Service, the Standard & Poor's, S&P
S&P and the Fitch Ratings. So all three of them have their headquarters in New York, USA. So remember that, and they are the most important and the most influential credit rating agencies in the entire world. For India, which are the important CRAs that determine all the credit ratings in India, they are the TransUnion CIBIL, Equifax, ICRA, Experian, CRIF Highmark, CRISIL, CARE, etc. And also remember the full forms of all of these things. So ICRA, it was earlier called Investment Information and Credit Rating Agency of India. CRISIL was called Credit Rating Information Services of India Limited, and CARE, it stands for Credit Analysis and Research Limited. So all these things were the earlier names. Now they are just referred to by their acronyms. So that is all about the credit rating agencies, and this ends our banking awareness series. So most of the important things we have already covered. Just a few more fringe topics are left, which I will be covering later on. But for all intents and purposes, the crux of this series is complete. I hope that this series helps you in all your banking examinations going forward, and I will definitely make more banking awareness content later on so that you can be helped in all the upcoming examinations, most importantly the SBI PO. I hope that you learned something from this video and that it was beneficial to you. If you enjoyed this video, please click on the like button and share it with your friends, and if you want to see more of this kind of content, please click on the subscribe button and do not forget to click the bell icon so that you, my friend, do not miss any future update. I'll see you in the next video. Bye.